Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta and with me is Nigel Dsouza, back with your daily dose of all things cryptocurrencies and commodities. But what is it that we have today, Nigel?
Well, it's Friday, so it's always special getting into a long weekend. But let's tell you first about the equity markets. And let's tell you first actually who all we have on the show. We have cryptocurrencies and metals that are top focus today. We have Dhruv of BigMint Technologies who will be joining in, and Paul of S&P Global as well. We'll talk all things commodities, focusing on the ferrous space, the iron ore prices that have been spiking up globally, and what's the sustainability of this sort of a mode in the ferrous space. But before we do that, a quick check on the global equity markets. Well, it was pretty much a lackluster session on Wall Street. The S&P 500 logged its third losing day as Meta and Microsoft, well, they failed to lift sentiment. The 30-stock Dow, well, it closed lower by roughly around 300 points. And back home, in Asia-Pacific, well, there's muted trade that's taking place. The South Korean market, that's leading the slide. It's down closer to around 2% or thereabouts. While the Nifty, that the last time I checked, had tumbled to the low point of the day. It's now trading below the 24,700 odd mark.
Well, it's all red on the screen there, Nigel, but shifting focus to the crude oil prices, and it's not very difficult here as well, or different rather. The prices have come off those 6-week highs, but are on track to close the week higher by nearly 6%. The price action follows the implementation of U.S. tariffs, as traders are now digesting the impact of trade policies on the economic activity. The dollar index, in the meanwhile, is holding steady, very close to that 100 mark, and ahead of that key now non-farm payroll data that comes in today in the U.S. markets there. In fact, the dollar is also poised for its best weekly close for this year till time. Well, as promised, let's start this conversation with Dhruv Goel, CEO at BigMint Technologies. Dhruv, hi, thank you so much for joining in. Your first reaction on tariffs, really, because that really seems to be moving the markets and prices. Steel already has 50%. Aluminum starts to get, aluminum also has 50%. Copper starts to get 50% from today onwards. How are you reading the tariff impact into the prices until now?
Thank you, Manisha, for having me here. As we discussed in the last meeting, that India exports very limited quantity to US. Directly, it has very limited exposure. So this 50%, 25% additional tariff will have very limited impact on the total export volumes. But additionally, there are indirect exports which happen from India. For example, solar panels are a commodity, or it's a very big market for Indian, producers and auto components. So that will get impacted, and that will have indirect impacts on the possible indirect impacts on the steel consumption, and will have direct bearing on the prices at the moment.
Okay, hi Dhruv, good to see you again. Dhruv, I wanted your take on the big spike we have seen in iron ore prices. Here in India, we have NMDC that's gone ahead and hiked prices in almost the peak of the monsoon. And the couple of factors that are playing out is global prices have moved up, and the recently concluded OMC auction, prices spiked up a little bit. What's your view? Do you think the near-term bottom for iron ore prices have been made? And how are you reading the demand scenario?
Yeah. So Nigel, as you remember, NFDC in their investors call mentioned that they would be adopting a new pricing formula wherein they have given 70% weightage to the global index, 20% to their own options, and 10% to the OMC prices. So if you see last month and this month's prices, the global prices have increased by 5%. So it has a 70% weightage. So that adds to 3.5. The local auctions have, fetched a premium of approximately 10%, which has a 20% weightage. So that is 2%. And OMC auction has fetched a premium of 3% month-on-month basis, and that has a 10% weightage. So if you add everything, that will, be approximately 7.8 to 8%, which NMDC has hiked their prices for the month of August. You are rightly that typically, miners do not increase prices in the month of monsoon because overall the steel demand remains weak. But maybe because of the new pricing formula which they have adopted, that the hike has been seen in the iron ore prices.
And with the way the iron ore prices have been moving, Dhruv, coming back to the overall pricing sense itself, do you see some further support coming in here? Because there's just so much moving right now, especially with Chinese statements, China tariffs with the US as well, and with the way that China is moving in sense of steel production, focus also on infrastructure and property and that big hydroelectric dam. How are you looking at that impacting demand?
So China, it is too early to say about the Chinese demand for several factors. If you see the June numbers, May-June numbers, they reported a very high export volumes. Reason being because of the 90 days cruise, everybody wanted to export out of China, so that was an outlier. But after the tariffs have been established, so probably we have to wait and watch what is the impact on the exports. But if you ask me on the ground, real estate is still not in a very good shape in China. Auto is doing good, but again after tariffs, that we have to see that what will be the impact on the export volumes. But overall, things are not very bullish at the moment in China.
So then what has happened to iron ore prices, Dhruv? Because I'll tell you what, it's a very, very confusing scenario that's playing out. One is China is producing less steel, which the global steel industry will be, very happy about. They'll be cheering that move. But
Yes.
exports continue to remain elevated.
Yeah.
So that in turn, in fact, will cap those pricing gains that we would likely to see. And if China is going to produce less steel, then that means iron ore demand as well will be lower. So how do you see iron ore prices pan out from here? Because extremely confusing signs that's coming out of China.
Yeah, so Nigel, there are 2 points. One, on the export front, in the first 6 months, the export volumes are higher by 9% compared to the last year, the similar period. But in the month of June, we have seen a slight dip in the export volumes. And what we expect that probably next 6 months, the exports volume may not be as high as what it was in the H1. So we feel that this will, rationalize. Exports will rationalize in H2. To answer your second question, that why iron ore prices are increasing when government is talking about production cut. So in China, it is typically, the importers take position, they stock it at the port, and then they sell it to the mills. So, when mills or or the government announced that there will be a potential production cut, we saw an increment in the Chinese steel prices. And that led to higher stocking of iron ore, which will again go to the Chinese port, and then it will move to the mills. So I would say the price hike, what has happened in iron ore, will not be. It is not something which will be absorbed immediately. So there is a period. So importers will stock it for a certain period, and then they will move it to the mills.
So Dhruv, at current levels or thereabouts at $100 a ton, do you see that prices sustaining? And as per BigMint House view, where do you see the iron ore prices range for this year?
Looks reasonable. I think we are projecting it to be anywhere between $90 to $100. Above that, it is not sustainable until unless there is any disruption from the supply side. But looking at the supplies and Chinese demand, we feel $90 to $100 are something where iron ore prices should be range bounded.
And how would you look at the steel prices therein? Because we've seen some gains in the last couple of months. We did see a 7-month highs on steel as well, but doesn't seem to be sustaining at those levels right now.
Yeah, so you're right. In last few weeks, the Chinese steel prices increased by $30 to $40. They started correcting in last week itself. So they have lost approximately $10-15 from from the $30-40 that they increased in last few weeks. As I said, that too early to say on Chinese demand and prices. Markets are very watchful, but overall, fundamentally, demand is still not so good. The production remains high in China, and exports will happen, but probably not at the pace what it was in the first half of 2025.
Dhruv, can you give us your take on coal prices? I was tracking the Chinese coal prices, which had crashed quite a bit. Obviously, we know that what happens on ground will be what happens in Australia as well. But coal prices have been rather weak. I spoke to two steel companies, JSW Steel as well as Tata Steel. Both have guided for softness in the consumption cost of coal in the coming quarter. Tata Steel told me by around $10 to around $12 approximately is what it could be softer after already softening by $10. What is your view on coal and pricing out there?
Yeah, so if you're talking about the coking coal, you are
Yeah.
right that there is a softening. Coking coal prices are softening. Major reason being that if you see the production numbers of all the countries, be it China, Japan, Korea, Europe, which are one of the major consumers of coking coal, so their demand of coking coal has reduced. On the other hand, supplies remain still intact. So we are very much aligned that coking coal prices will remain under pressure or will remain subdued next quarter as well.
Dhruv, how are you looking at the rest of this year then? Because there's just so much to watch out for. I mean, there is China to look at and the tariffs to look at as well. So how, demand and supply is, of course, on one side, and that would be resultant of the kind of economic data that we continue to see. But for somebody who's watching the space, what should they be looking at?
From an Indian context, we feel that probably this year is still, hard for mills. Demand, or maybe I would say more than demand, there are a lot of supplies which are in the pipeline, which have already commissioned. So maybe demand may be growing at maybe 7-8%, but supplies are still growing at a faster pace. Although mills, the producers or the industrialists have slowed down their capacity expansion, but still whatever is planned will come. So I think more than demand, supply is a problem, which we feel that probably will remain for 26 as well.
All right. So more than demand, supply is a problem, and we could be looking at higher supplies, not just this year, but the next as well. Dhruv, thank you as always so much for joining in and giving us a sense on tariffs and, of course, the Indian pricing and on where the markets really could be moving from here, where we do see some pressure continuing for iron ore. But for steel, it really would be about supply and China measures going on from here in sense of demand. But with that, it's time for a short breather on the show. On the other side, we talk all things metals with Paul Bartholomew of S&P Global Commodity Insights. Stay tuned in. Welcome back. Let's talk some more metals now. And Paul Bartholomew joins us now from S&P Global Commodities. Paul, hi. And the first thing that I want to talk about really is copper. Very sharp correction there. It's down 26% on the week as more clarity emerges on that refined copper is not part of that 50% tariffs that US has implemented from 1st of August. With the kind of correction that we've seen in prices, what's your sense from here on? Would you see a lot of copper moving around back into LME now?
There was a lot of kind of restocking of copper sort of at the start of the year, which has sort of resulted in those very strong inventories. I guess that's also been supported by some pretty strong production as well coming out of South America. We do see those inventories sort of starting to gradually sort of decline, but I think copper, like most of the all the metals that we might discuss are is being impacted by I guess soft end user demand. Of course, there's also the the currency, US currency aspect that sort of plays into to copper as well. But yeah, I think we do see some sort of weaker imports. Having some certainly into the US over the second half of the year, helping to sort of bring down some of those inventories and also held at warehouses and helping to kind of support prices a bit.
Well, Paul, India's tariffs are fixed at around 25%. And India, as we know, is one of the biggest growing metal consumers. And there's a tariff in excess, there's a penalty tariff in excess of the 25% tariff that they're talking about. How do you see this impact the sector, the industry, demand on ground?
To be honest, I was actually thinking today a little bit about the potentially this penalty tariff on India for continuing to import from Russia. Certainly, perhaps having some I guess impact on a certain type of metallurgical coal that India imports a lot of from Russia, sort of PCI, whether that's going to continue because Russia's been the major supplier to India of that product. Certainly if, India is going to get sort of hit with some of these additional tariffs from the US. So that was sort of one thing we were thinking about, whether that means India might sort of turn around to other suppliers, perhaps turning back a little bit to Australia to get that, source that PCI coal from there. But I think it's just one more market dynamic that everybody is sort of trying to get their heads around at the moment. So I'm not sure. I think where India's concerned, I think the main sort of dynamic really is the strength of the domestic, economy, strength of the domestic consumption. At the moment, obviously the monsoon season still going on, which we've seen resulting in sort of slightly reduced steel production and sort of a softer price environment. But we think India's probably going to start sort of picking up again around September, which will support some of those prices.
Oh, well, absolutely. Paul, with 50% now on copper and steel and aluminum, have you had the time now to wrap your head around the calculations and the demand therein, the impact that is?
Well, I suppose we've had a few months now to kind of get our heads around and prepare for, I guess, some of the tariffs and some of the potential implications. It's all moving so quickly, obviously. With we just discussed the additional tariffs on India. Obviously, the US and Europe have been talking this week. They've got a separate deal with the UK. I think the sort of overarching thing for all the metals, really, compounding some of the challenges caused by the tariffs, is the fact that demand is still pretty soft, really. If you look at aluminum or aluminium, it's still quite a soft demand environment in construction and auto. And steel, in the case of China, consumption is sort of a bit softer, I guess, because of that ongoing weakness in the property sector in China, which we expect to continue, really. I think that's a kind of structural shift. But I think, also I think some of the Southeast Asian countries are being hit quite hard, although I think Vietnam's got slightly better terms, and Vietnam is quite an important player these days in, I guess, the steel supply chain. A lot of sort of steel can pass through. So I think that sort of lack of sort of demand is probably the overarching factor. But I think all countries are obviously worried that steel being pushed out of the US is going to sort of end up in their markets, which is one of the reasons we've seen the safeguard duties in India, another kind of anti-dumping duties. But what's been interesting is that overall China's still exporting a lot of steel. So in the first half of this year, its finished steel exports were up 10%, so a lot higher than we were expecting at the beginning of the year. We thought some of the tariffs, some of the anti-dumping duties would really start to sort of bite, and they haven't yet. We do see softer exports over the second half of the year potentially, but we're still seeing another bumper year of finished steel exports out of China, probably around similar to last year, 110 million tons. So I think that's something overhanging the global steel market still.
All right, Paul, steel prices are near 4-month highs. What is your sense on China's steel prices and demand fundamentals as well out there?
I think in China we have, for the main steel products this year, we have a sort of year-on-year decline of around about 10%. At the beginning of the year, we were thinking probably more in the region of a decrease of 6 to 7%. So we do see that ongoing weakness in China. Production is still pretty high. We think it'll be a little bit lower than last year, but second half tends to be a bit softer. But as I mentioned before, those steel exports are still very high. They're kind of offsetting, I guess, the sort of softer domestic consumption. I think in the US we did see we've seen a couple of price spikes sort of this year. I think firstly when the Trump administration took over, and then again once the steel import tariffs were doubled to 50%. But we do think probably third quarter prices will sort of come off a little bit as the again, as I mentioned, the demand, the fundamentals, not really supporting ongoing high steel prices. I think also in the US, the market still, investors are still kind of wondering to what extent, they're going to invest in new, operations there, this kind of thing. There's a lot more steel capacity due to come on in the US, but I think the good news story is not quite as rosy as you might think. Again, because the demand is still a bit soft in the US as it is in other regions.
Paul, I just want to go back to China yet again, and we've been waiting for that stimulus measure forever, hasn't come. Well, China did announce that dam announcement, and that did lead to prices gaining across sector, whether it was copper and steel, aluminum, iron ore, etc. But that surge also seems to have hit a pause now. Would you say that China perhaps needs to do more, say more, do a follow-up on certain things?
So there was a bit of a price uptick once that big sort of kind of dam was announced. I mean, I think really because it sounded a bit like there was going to be some return to more traditional types of infrastructure, very steel intensive infrastructure. Because I think a lot of the time now when China talks about infrastructure, is looking more at what they call soft infrastructure. So 5G and networks, this more digital type of stuff rather than the old bridges and ports and railway. But so I think the market sort of thought there was a return to that, but we don't necessarily see infrastructure demand coming back in any big way. We see a little bit of growth this year, but certainly not enough to offset the weaker property market. In fact, we think that probably by the time we get to 2026, in over a sort of 5 to 6 year period, we've seen the steel consumption in the housing sector, the property sector, really come off by about 150 million tons a year. So, or compared to what it was back in 2021, so a big sort of drop off. So. Again, we think that's structural. We don't think that's going to kind of rebound in any big way. Some of the other sectors have got a bit of growth, shipping and sort of auto and that kind of thing, but they're not as big a contributor really to steel demand as some of those other sectors. And manufacturing, I guess, is the big one really, because that's where I think has really been seen as the kind of the white knight, the driver of steel consumption this year. But so I think those import tariffs are very sort of worrying, because it's not just steel exports, it's really the export of Chinese finished goods, and if they get impacted more by tariffs, then that's going to push back some of the demand for some of the flat steel, which is largely what's being exported at the moment. So I think another sort of trend we've seen a little bit over the last couple of years is a lot of anticipation ahead of these big government meetings, whether it's the plenaries, the one you mentioned, or the annual government meeting in March. But it generally doesn't have, if it does have an impact, it doesn't last for very long. You might get a bit of sentiment driven sort of price uptick, but really it very quickly reverts to fundamentals, which are quite soft on the whole, really. So it seems to be a sort of theme we've seen, anticipation sort of followed by disappointment really around a lot of these these big meetings.
Paul, are you bullish or bearish on metals from here on? Tariffs perhaps will settle in August, September, and then demand supply will take over. So how are you reading the dynamics?
Generally, the July, August period is quite a soft one, not just in China, but other countries, Europe, US, because of the holiday, the vacation season. In China, it's one of the seasonal low points, really, because of the the hot weather and the rains in southern China. It, pushes back on demand, that kind of thing. So I think we're sort of expecting a sort of slightly softer third calendar quarter in China, perhaps a bit of a pickup towards the end of the year for steel, at least, as sort of there's a bit of restocking ahead of the winter and Lunar New Year in the first quarter of 2026. But I think, as I say, there's been pretty strong, copper production. So those inventories are coming off. Aluminium is being really impacted by the softer sort of demand from the construction, the auto industry. Auto has been very impacted by the import tariffs again, which is having a lot of downwards impact in Europe, places like Germany. So I think a lot of those countries that are very export dependent, South Korea, Japan, Germany, used export a lot of high-end manufactured goods, cars, etc. I think they're going to find it sort of pretty tough. So I think we see the tariff situation having a sort of kind of eroding sort of influence on demand and therefore prices sort of as a whole. So it's a bit difficult at the moment to see too much upside. We've got a soft sort of third quarter, I think, for most of the metals that we cover. But I think there's still very much a sort of wait and see mode in the market, waiting to see what's going to happen once all these certainly the August the 1st is going to be a lot of tariffs finalized. Are there going to be more sort of country by country agreements, but also I think a kind of combination of bearish sentiment, uncertainty really is probably the key word. All of those are going to have a sort of downwards impact on prices, at the same time when production or supply is pretty healthy in most cases. So yeah, I think at the moment it's a bit sort of difficult to kind of see too much price upside over the rest of the year this year, given all of those factors that we've been discussing.
Paul, we hear you when you say it's a wait and watch kind of a scenario right now. And yes, this is also a season which is slightly slow in sense of demand, cyclical as well. So that perhaps could put pressure on prices as well. And Nigel, both our experts on metals today have said that Q3 is going to be slightly weaker when it comes to metals. So not too much of a buying expected, perhaps.
And by Q3, at least we'll be having clarity with President Trump, hopefully. Okay. All right. On that note, though, we'll have to wrap up with this edition of Big C. Thanks a lot for watching. More news and updates on the other side.